Data Financial Accounting, we talk about accounts receivable. So basically, how do companies recognize accounts receivable? And we'll talk about both accounts receivable and notes receivable in this chapter. But companies that sell product or sell services many times bill out their customers. If they send their customer a bill and that customer then has so long to pay them, that's an accounts receivable. A notes receivable is normally something that takes a little bit longer. So maybe they sell a high ticket item to their customer and their customer takes 90 days or 120 days to pay. So that might be more of a notes receivable. So here shows you some different companies and what their receivables are as their total assets. So you can see when you look at those companies like the Ford Motor Company, that's a very high receivable because all of their dealers would owe Ford for those cars that are on their lots. So they only pay Ford as those cars get sold. Until they're sold, it's a receivable. General Electric obviously is our utility company. So I mean, everybody across America owes so much on their utilities every month. So that would be a large receivable to them as well. Then you can see they start to decrease down. So some of these customers or some of these companies maybe just sell to consumers. If you just sell to consumers, consumers primarily pay you with credit cards or cash or check, so you really do not have receivables. So what issues that we'll talk about in this chapter is recognizing them and valuing them. And then hopefully when we dispose of them, hopefully it's by the customer paying us. That's the most common way, but we will talk about bad debt because then sometimes customers don't pay us. So again, we've got the difference between a service organization and a merchandiser, but both of them would end up having accounts receivable. Service, they're going to bill for their labors performed, and a merchandiser is going to send a bill for the inventory that they sold them. Here we have an example. This company sells merchandise on an account to Polo Company for $1,000. So when we record that journal entry, we're going to set up the accounts receivable by debiting it, and then we're going to record the sales revenue by crediting that. So that increases the receivable, increases what they owe us, and then increases our revenues. Okay, then now they returned some. So they returned some merchandise. So again, think back to our inventory chapters, similar kind of scenario, except for now our customers are returning it to us. So we're going to debit a sales return and allowances, which is a contra account to the sales. So again, think of your multi-step income statements that we talked about again with the inventory transactions. We had sales returns and allowances. So here, that's where that's coming in. So that would reduce the sales. But then we're focused on the receivable side. So we're going to reduce the receivable. If they return the merchandise, they no longer owe us that $100. Okay, then they pay us on July 11th. Now in this case, they paid us within the term, so they get a 2% cash discount. So they owed us $900 after this return. They get a 2% sales discount for paying us within those 10 days. So then the cash we receive is the $882. And again, we have another contra sales account for $18. And then we reduce the entire accounts receivable. Okay, so we basically want to value the accounts receivable at our net realizable value. What do we really think we're going to collect? So there's going to be times where we realize that some of these accounts may be uncollectible, and we may have to charge those off to bad debt expense. So there's a couple different ways to do it. A direct write-off is, it would be the easiest, but theoretically not the best. So we're not matching it to the time that we determine it becomes uncollectible. There's no... your receivable would be at that gross amount, the total amount, until you actually write it off. So it's not what GAAP requires. So GAAP requires us to do this allowance method because it does, at any time we look at our financial statements, our total accounts receivable will be at their realizable value. So how do we do that? So we have the Warden Company writes off this M.E. Doran's $200 balance as uncollectible. So when they write it off, they're going to charge bad debt expense, and then they're going to credit the accounts receivable to take it off the books. And again, this would be the direct write-off method. So this is not following GAAP. Again, that receivable was not at its net realizable value. So what we want to do is to estimate our uncollectible accounts and then charge those in the period that we determine they become uncollectible. So we will debit bad debt expense and we will credit, instead of like on that last slide we were just crediting accounts receivable, now we have this new account called an allowance for doubtful accounts. So we will credit that out. Then as we deem invoices to be uncollectible, as we determine that that is a bad debt, then we will debit the allowance for doubtful accounts and credit the receivable to write that specific account off. So here we have an example. If they have credit sales of $1.2 million and 200,000 of the receivables remains uncollected, the credit manager estimates that 12,000 of those sales will be uncollectible. So again, it's just an estimate. He doesn't know for sure. So he's going to debit bad debt expense for the 12,000 and then set up an allowance for doubtful accounts for that $12,000. Then now he's got this kind of pot of money that as he realizes, hey, some of these people aren't paying, this really is bad debt, he can take it out of this allowance for doubtful accounts. So then now here's their balance sheet, and then this is where we have it at that realizable value. So their total accounts receivable is $200,000. Again, based on his judgment, 12,000 of that is uncollectible. So when we bring that over onto our balance sheet, it's 188,000. So that is our realizable value. Then we have, okay, now he's going to write off a specific balance. So this R.A. Ware owes him $500 and we recognize it is going to be uncollectible. So then we are going to debit our allowance for doubtful accounts and then credit the accounts receivable now that we've identified a specific balance. And that would be our journal entry. So then here we have, again, this is comparing the before the write-off. So we had the $200,000 gross, the allowance for 12,000, so we have 188. Now that we've identified a specific one, you can see we reduced it here, but we took it out of there. So our balance, our net realizable balance, is still the same. So that remains the same even after that specific write-off. Okay, now it says, what if the guy actually ends up paying? So we wrote it off thinking he's bad debt, but now he really comes through and he pays us that $500. So then now we need to put it back into the accounts receivable file and then credit the allowance for doubtful accounts. Then we can record the cash and reduce the accounts receivable. And then you might be thinking, well, why do I have to hit the accounts receivable twice? Like, why can't I just debit cash and credit the allowance for doubtful accounts? Because the accounts receivable ledger has detail in it. So the detail shows it by customer. So then we can go specifically to this R.A. Ware's account and say, oh, look, we wrote his $500 off, but then he ended up paying us. So we put it back on the books and then he paid us. So then you have a proper trail of the money that comes in. Okay, then we have, well, that we already, we kind of did this a little bit, but now it's a percentage of our outstanding receivables. So instead of just the manager saying, hey, it's a dollar amount, we're going to look at our accounts receivable and say it's a specific percentage, but it's going to be based on how old the debt is. Because obviously, if it's not due yet, these people are probably going to pay us. I mean, we should feel fairly confident that they will pay us. When we come over to these ones, it's been 3 months and we haven't seen any payment. There's a far better chance that those people are not going to pay us. So then you can see the percentage goes up. So this is a little bit more complex than just the accounting manager estimating it. This is saying, okay, we're going to kind of tier out this aging schedule and apply a specific percentage to each. So then the 2% times that 27,000 gives us 540. 4% times the 5,700 gives us 228, and then so on the rest of the way down. Then we add all of these tiered out amounts for a total. So then we want our uncollectible account to be, our allowance for uncollectible accounts to have this balance. We want it to be $2,228. So that's what we want it to be. So then we go back to our trial balance and say, okay, well, what is it now? So now it's $528. We want it to be $2,228. So we need to do a journal entry for the difference. So we need to debit bad debt expense or charge bad debt expense for $1,700 and then increase the allowance for doubtful accounts by $1,700, which will then bring it up to that $2,228. Okay, then now, what if it goes the other way? What if we didn't have a credit balance, but we had a debit balance? Then in that case, we've got to get rid of the debit balance and then make it a credit. So then that entry is going to be the $2,728. So it's $500 more because we got to get rid of the debit. So this allowance for doubtful accounts should not be a debit. We want it to be a credit. It should be reducing our accounts receivable, bringing our accounts receivable down to that net realizable value. So this isn't good. So that's why we got to get rid of that and then bring it up to the balance we want. So we'll have to do an entry for basically the 500 plus the balance we want. Okay, then how else can we dispose of accounts receivable? Sometimes companies need cash and they need cash quickly. So they can't wait the 30 days or the 60 days for their customers to pay them. So they may end up selling those accounts receivable. So who do they sell them to? A finance company or a bank, somebody who's willing to wait to collect the payment from the customers, but they do charge a fee. Obviously, they're not going to do that for free for the company. So they'll say, okay, hey, so for 3% of the receivable dollar amount that we're collecting, we'll charge you that and we'll go ahead and wait for the company to pay. So here we have an example. If they've sold or factored $600,000 of their receivable and that federal factors charges them a 2% fee, then here would be our entry. So the 2% is the service charge expense. So the $600,000 times the 2% gives us a $12,000 charge. So we're going to charge it to service charge expense. We're going to reduce the accounts receivable for the full amount, and then we'll accept the cash for the difference. So again, we're taking a little bit of cut in the cash, but we're doing that so we can have our cash right away. Okay, then like I said on that, when we were looking at those different customers or different companies, I said sometimes customers pay in cash or pay in credit cards. So here's an example of a company that has their customers pay them in credit cards. So in that case too, the bank charges a fee because the customer is going to give their credit card and they're going to pay the bank. So the business gets their money right away. So they receive their cash, but again, less that service charge. So that service charge expense is going to be 3% times the amount that they charge, or $30, and then they'll have sales revenue of $1,000. So again, they're recording the gross sale of the product, but then they're accounting for that bank fee as a separate service charge expense. All right, then we get into our notes receivable. So like I said, sometimes instead of having an accounts receivable, it's a notes receivable, and normally it's a longer term of a receivable. It goes a little more than 30 days. So here's an example of what a note would look like if it was, again, made between a company and, it's two different companies here. And then you can see the due date is within 2 months. So the key with the note receivable is then we're going to charge them interest. So we don't extend their terms and give them 2 months just out of the goodness of our hearts. we do it and we expect them to pay us interest. So then how we calculate that interest is it's our formula, interest equals principal times rate times time. We learned that in business analysis with algebra. So whatever the note value is times that annual interest rate times the time. And the time could be, here we give you some examples, it could be in days. So here you have the face amount times the rate times the time, and it's 120 days over 360. And then you might think, well, why 360? There's 365 days in a year. And 365 days can be used if it would say exact interest, but banker's interest or ordinary interest always uses the 360 days. So that is by far the most common to be used in businesses or with banks. So we put the days over the 360 to calculate the interest. Could be in terms of months. If it's in months, we leave it in months. So 6 months over 12 months, or in terms of a year. And again, if it was in years, we'd leave it in years to calculate the interest. Okay, so here we have another example. Now they wrote a $1,000 2-month 12% promissory note dated on May 1st to settle their open account. So they owe them, but they need a little longer to pay. So again, we're going to do it, but we're going to charge them interest. So here we set up the notes receivable. So we debit that creates the note receivable, and then we relieve or get rid of their accounts receivable by crediting that. Then we charge them interest. So here we have 4 months where it's $10,000 times the 9% interest for 4 months. So then that would be the 300, where that $300 is getting calculated. Okay, and they will, and then I'm not sure why we've got it broken out into that 1 month, but maybe that's when it's due. So then we'll get that other $75. So here we have an account, the interest receivable that we're setting up for $300, and we're recording that interest revenue. Okay, so then here they pay us. So they pay us the cash of the $10,375. So we're alleviating our notes receivable. We are alleviating the interest that we accrued. And then again, that's that final month, that $75 that was on this last slide. That would be in the current month. So then that's why we have that as the interest revenue. So these two were already on our books, and now we're taking them off. And then this is a new entry to record the revenue. Now then sometimes say notes can be dishonored or not paid, as well as what we talked about with accounts receivable. So in that case, we would take it out of our notes receivable. We would reverse the interest revenue that we recorded, and we would put it back into accounts receivable. And then we would charge it off to the allowance for doubtful accounts, just like we did on the accounts receivable part. Okay, then our last section, we talk about, how we look at how we analyze and look at these accounts receivable on our balance sheet. So they're in the current assets section, and normally the accounts receivable and the notes receivable, as long as they're under a year, they'll be in that current assets section. And then we will have the interest revenue and our other revenues in section of our income statement. And then bad debt or service charge expense would be in our income statement. So here they show a little snippet of the balance sheet where, again, we've got the different receivables. And this particular company has a variety of different ones. So there's a lot of detail to that one. Then what we would do is we would compute some ratios. So we would do the accounts receivable turnover ratio. And what's that is saying is how many times do we turn over our receivable in our sales? So we take our net sales divided by the average accounts receivable. So to calculate that average accounts receivable, it's your beginning receivable balance plus your ending divided by 2. So that gives us our average. And then we say, okay, we turn over our accounts receivable 7.2 times. Well, then you may think, well, I don't know if that's good or bad. So then the next computation kind of puts it into perspective. So then if you take the 365 days we have in a year and you divide it by the 7.2 times, this tells you it takes 51 days to collect that accounts receivable. So then you'd think, well, I don't know, does that seem good or bad too? What you really have to do to judge it is look at what their terms are. So if that company has given them 30 days to pay and the average is 51, then that's not very good. You'd want to probably do something to try to get them to pay quicker, put a little more effort into your collection process, or even maybe who you're selling to. Now, if your terms were 45 days, then that's not bad. You know what I mean? It's reasonable. If your terms were 60 days, well, then that's awesome because you're collecting even before your due date. So again, you have to use a little bit of judgment when you review those. Okay, so that is our accounts receivable.